All right, again, everyone, thanks for joining us tonight for Operation Homefront, Home Ownership Basics for the Military Community Explained. As a reminder, please mute your mics and keep your cameras off until the question and answer portion of tonight's webinar. Also, please review the chat where momentarily the items will be placed. Please review it throughout the night. There's going to be, if you want to save the chat, please go to the chat and click the three dots on the side where the smiley face is. That way you can save the chat. Now, this event is being recorded and will be placed on TVC's YouTube channel. As a reminder, this is the first of a four-part series. I will mention the rest of our events before we end tonight's webinar. Now, we're going to give folks a few minutes to log on, and we're going to get started shortly. As a reminder, at the end of the webinar, there will be a drawing for a $50 gift card. Or if we have two competitors who are pretty close neck and neck, we can provide two $25 gift cards. Now we're waiting, before we get started, Mr. Dominic and Miss Brianna, if you want to just place in the chat where you're located so we could know that. I know that we had people in different time zones reaching out to us. That'll be kind of good to know. We're gonna see who's, okay, Grapevine, Mr. Dominic, is that in Texas? And if you could keep answering the chat, that'd be great. Dallas. Okay, awesome, awesome. Now, don't get mad, but I've heard of the Grapevine dance when I do aerobics. I didn't know that was actually a city, but you can't put nothing past Texas. We have some wonderful names in the state of Texas. Awesome sauce. All right, we're going to give it one more minute and we will get started. You see Brianna's from Dallas, home of the Mavericks and the Cowboys. Now I'm in San Antonio where we have the beautiful, lovely Riverwalk. Yay. All right. All right, team. So we're going to go ahead and get started. Good evening again, everyone. My name is Sharon Stewart, and I'm the Women Veterans Coordinator for South Texas, Texas Veterans Commission. I am a proud Army veteran. I spent 21 years, 6 months and 20 days in Army, not that I counted, but during my first 11 years in Army, while I was enlisted, I was a photojournalist, and I spent the last 10 years of my military career as a signal officer. So I want to start off by thanking you and welcoming you to Operation Homefront, Home Ownership Basics for the Military Community Explained. And tonight you're joining us for the reconnaissance portion of the home buying mission. And hopefully this will cause you to be aware of some very important factors before you purchase a home. Now, we do not pretend to have all the answers. We simply want to empower you, our fellow vets. Now, twice during my military career, I was a plans officer. So for those of us who had to recon missions, planned routes, exercises, weapon ranges, or even look for locations that have a physical fitness test, we know that a thorough recon is one of the most important factors for a successful mission. Now, as a quick reminder, the Texas Veterans Commission is a state-level agency that provides assistance to the military community, such as filing for VA disability claims, mental health advocacy and training, education, employment, entrepreneurship, grants, healthcare advocacy, and we're one of the few states in the nation with a robust women veterans program. Our Women Veterans Program consists of our program director, Dr. Krista Matthews, who along with being the program director, she provides assistance to women veterans in East Texas, Catherine Smith, who covers North Texas, Cynthia Lindoff, who covers West Texas, and myself. And of course, I cover South Texas. And we're all very proud of our military service. Also, please know at the Texas Veterans Commission, we do not turn anyone away. Approximately 30 to 40% of the clientele that I assist are male. And also, please be advised that conducting this event and the following events do not denote an official endorsement by the Texas Veterans Commission of any of these agencies, services, goods, or products. But we do want to acknowledge and thank all the participants who are volunteering their time and expertise to help us today. Now, I will ask some general questions after Ms. Jeremy Chavez speaks. She's going to give a phenomenal presentation, and the person who answers the most questions right will be the recipient of a $50 gift card. Now, if we have two folks who are pretty much tied neck and neck, we can present two $25 gift cards. The gift card winners will be announced at the end of the webinar, but right now it might be a tie. I think we might have a tie going, which is okay. Now, please allow me to introduce tonight's facilitators. I'm going to introduce Miss Jeremy first. She is my fellow Army vet, and she's also known as the Health and Wealth Chica, and she's an accredited financial counselor. And we also have Miss Rachel Ray Roach, a proud Air Force retiree and an agent with New York Life. Now, talking to these ladies as we plan this event has helped me tremendously. And I even made some adjustments to my finances. They're just a treasure trove of knowledge. And thank you so much, ladies, for being available tonight to provide your expertise with our community. We greatly appreciate it. So Jeremy, ma'am, since you're the first to brief tonight, can you please tell the audience about yourself?
Sure thing. Thank you very much, Ms. Sharon, for the opportunity. And hello, welcome everybody here tonight. We really appreciate that you took a little time for yourself to get information, gain knowledge. We're really excited for you because tonight we are going to be in part 1 of Operation Homefront. And we want to give you that recon. What should you know? What should you be looking for? But again, my name is Jeremy Chavez, like Ms. Sharon said, and I'm here to present the Operation Homefront Reconnaissance, Get Ready for Home Buying. So can we get started, Ms. Sharon?
Yes, ma'am, take it away.
All right, great. So, okay, so here's a little quick introduction of myself. So I am a U.S. Army veteran, and I served 4 years on active duty as a military police. As Ms. Sharon mentioned, yes, we all are very proud, and we should be. Also, I'm very proud of the fact that I'm also a retired Army wife. And so I give my husband the most credit because he actually did with what Ms. Sharon and Miss Rochelle and some of y'all out there as well did. They did the 20 plus years, and so I'm really proud of him for that. I'm also a mom of 3 kids and a couple fur babies, actually 2 dogs and 1 rabbit, so technically it's 3 fur babies. And also I'm an accredited financial counselor, so that's when you'll see that AFC after my name. You'll know what that acronym means. And I love empowering people, especially women, around their money. And my slogan is manage your money like a boss to live your best life. And so let's go ahead and get started. That's a little bit about me. So we're here to talk about home ownership in 2022. And you know, buying a house is a big deal. And so I give you kudos. Many people will go into home buying and they won't know necessarily all the things that they should know to prepare themselves to be successful homeowners. And then sometimes they'll end up in my office. And so I'm happy that you're going to get some of this information. But you know, you do have to be financially ready because there are some repercussions for years to come. If we rush into it, we don't have all the information we need. So I'll go over some facts and that go into the decisions to help you to figure out if you are ready to buy a home. And some great first steps to align you with that home buying goal that you might have. Okay, so let's first talk about, before we delve into some tips I have for you, what have we been hearing in the news? We've been hearing a lot of things about home buying in 2022, haven't we? So we've been hearing things about increasing interest rates, housing shortage, inflation, recession. So hearing all this, the things in the news, and generally they're not positive, are they? So it could leave us a little bit confused and concerned and not really sure if home buying is even in your cards for 2022. So I'd like to talk about these because these are facts. It is true what is being said on the news, but I'd like to offer a little perspective behind what we're hearing. So here we see some facts, more facts for you, so we can gain some perspective. But I'm showing you here a graph of the annual average 30-year fixed mortgage rate since 1972. And you're probably wondering, like, why are you showing me this from way back from 1972? Well, the reason I want to show you this is because this graph shows from 1972 all the way to 2021. And this is how we can start seeing historically some facts about interest rates and start gaining that perspective that's so important. So when we do hear things on the news, and sometimes, let's be honest, they put a little hype in there to get us to click and get us to watch. So this will help you to really gain that broader historic understanding and gain that perspective. So as you can see here, simply the source is Freddie Mac, but they've been tracking the average of the annual percentage rate over the years from 72 to now. And you can see how it started out hovering over 6, it went up, it peaked, went up into about 16% range, and then it came back down. And ever since, it's been trending down. Okay. All right. So let's go ahead and look at a couple years to just further investigate and gain some perspective. So the highest year we peaked out at was, as you can see, it was 1981. And I know it's hard to see here, so I'm going to show you a better view. But we're really looking at 2 years, the 1981 and the 2021. Okay, let's go ahead and focus in then. And we see 2021. Now you're saying, Jeremy, but we're talking about 22. Yes, you are correct. However, this is as far as we have. I'm sure by the end of the year that Freddie Mac will give us what the average was for 2022. But the point of me showing you this is that 3.15 in 2021 was really the historic low ever in the history of when we've been tracking. So we see that the interest rates really were at the lowest possible ever. And so in 2022, they did start to gradually come up just a bit, but then now you understand, even if they are between 4 and 5%, you know, I checked today, what is the average mortgage rate for 30-year mortgage today? And of course, it's going to be based on different variables such as, you know, your zip code, your credit score, you know, your debt, and those kinds of factors. How big will the loan be? In general, it's between 4 and 5% today. So not far off from the all-time lowest low in 2021 of 3.15. And so I just wanted to point out that in 1981, by the way, when it was the all-time highest tracked interest rate, 16.64, I want you to know there were still a lot of people becoming homeowners in that year. A lot of people. Actually, my parents, I was having a talk with them about how interest rates have been at all-time historic low for the last couple of years. And they were reminding me that back in the 80s when they bought their first home, they were first-time homeowners, that they actually qualified for a nice, decent home, which I grew up in. No complaints there. and they paid somewhere in the range of 18%. So homeownership can happen even as we see the interest rates inching up. I want you to walk away with that if that's the only thing you walk away with. But now we've looked at those things and we've kind of set aside some of the questions, concerns, worries, maybe even that you might be having around homeownership. Let's delve into some common pitfalls I have here for you, because these are important. Again, I'm an accredited financial counselor, and I see clients come to me with different, I would say, obstacles around their mortgages. And I've seen a trend. So here's the first one: overlooking the rent option. This might seem like, why is this a common pitfall? I just want to say why. The reason why is because there are so many pressures external. We've just talked about some of the news. You know, they might make it sound like the interest rates are going up, so you better buy now, right? So we have some external pressures. Maybe those are coming from even well-intended family and friends, right? Oh, you've got a great job, you know, you don't have a house yet. You're in your 20s, your 30s, whatever. So we've got these external kind of pressures. And then on top of that, internally, you may be looking around, even if no external pressures are affecting you or having an influence. You might look around, you know, and see your peers buying their homes, and maybe you're thinking, maybe I should buy a home, right? And it's all good. So I just want to bring that up. So I'm here to tell you that home buying is not something to be pressured into or to rush into. And actually, I do have a handy rent versus buy calculator. And what I love about that one, and I know Ms. Sharon will share it at some point, but this calculator will help you to run the numbers. So emotions aside, if you want to make just an objective, rational decision and you want to look at the numbers, you can put in the calculator, what if I stayed renting? Even if you decided to rent in a different home than you're renting now, or I went on and bought, you can put the variables in there. And then at the end of it, it will tell you which is better for you. If buying is cheaper for you, or if it's renting, and it will tell you if you went and bought, you know, it will tell you how long you need to stay in that house for it to have made sense financially. So it's a really cool tool. I highly recommend it. And so that's number one pitfall. Let's go ahead and go into another pitfall. Here we go. Preparing for homeownership less than 1 year away. This kind of ties back to what we were just talking about. We don't rush into it. We shouldn't be pressured. And we also want to, you know, I know that it's exciting to have, you know, the prospect of being a homeowner and buying a home. And at the same time, I also acknowledge it could be nerve-wracking. It could be both. It could be all the emotions, right? But what we don't want to do is let those emotions have us make this spontaneous or rushed decisions. And it's beginning to think about it seriously. At least a year out will go a long way for you to be prepared to be a successful homeowner. And so what I mean by successful homeowner is really get into this home that you can afford, that you can maintain for years and years and years and decades to come, not just the first 1 or 2 years. And then, you know, something goes wrong, that maybe even just an increase in insurance or taxes throws you off because we weren't really taking that time to be fully prepared to be successful homeowners. So that's what I mean by successful homeowner. Actually getting to buy and keep that home for a long time. And so realistically, I would say about a year. It's going to be dependent on, you know, where you are with your credit score, where you are with your debt and your savings and other goals that you have. So I find that a year is a good base to start learning also not only your getting your financial things in order, but also doing research on the different mortgage products and the way mortgages work and those types of things. Okay. All right. So here's another pitfall for you. Relying on lenders to tell you what you can afford. So there is a huge difference between what you can afford technically by the numbers versus what you can afford to maintain your lifestyle. So there are those are two different things, right? So a lender will calculate if financially you can swing this mortgage payment. But what you'll find, and if you've been a homeowner before, and you might have noticed that when the lender is getting all your financial information, they're getting the basics as far as what are your income, what are your expenses, right? But are they really sitting down and having a chat with you the way a financial counselor like myself would, and asking you, what are your other goals beyond home buying? Do you like to go on a trip, a family trip once a year? Oh no, not once a year, twice a year? That's awesome, great. You know, those are the types of conversations and questions that are left out when it comes to home buying. The lender is not really seeing the whole financial picture. And so that's why I say, don't just rely on the lender telling you what you can afford. You've got to know and understand what you can afford, not just by the numbers, but also all the other goals and all your other things that you would like to accomplish. Okay. And so this is our second to last common pitfall, and then we're going to get into the tips. What can you do? What are some step-by-step things that you can do? All right, so here we go. Another common pitfall is not knowing first-time home buyer programs. For me, this is the second to most important thing for you to know, because when we depend too much, right, we just lean too much on the lender. We don't know if the lender is a newer lender, not as experienced. We don't know. We hope that we would do very good research, right? But we'll talk a little bit more in a little while, in a few slides, that most people don't do a lot of research. So if we rely too heavily on the lender, that lender might not know some of the first-time home buyer programs that are out there that you would actually qualify for and save a lot of money with. So I challenge you to put that responsibility on yourself. And if you're thinking, well, I didn't know there were even first-time home buyer programs out there, there are. And so one thing to know about this is don't exclude yourself if you have been a homeowner in the past, because first-time homeowner definition is slightly different from what it sounds like. And so just to reference one of the programs that Texas state has. So if you're in the state of Texas, there's a definition that the Texas state uses for first-time homeowner, and they say it's any person or family who has not owned or had ownership interest in a home within the past 3 years. See what I mean? So I definitely would check those out. You can do a Google search, but I've also provided Ms. Sharon with a link to provide to you so that you can check into this for yourself. We are heroes in here. We're veterans. If you're active duty, well, you're in that number, right? Also in police, things like that, the heroes, Texas has a Homes for Texas Heroes program. And they may provide down payment assistance. They might provide mortgage interest tax credit. So you'll have to get the juicy details from the website. And we know that most veterans that serve will qualify for the 0% down VA home loan. I get it. So if you're telling me, well, I don't have a down payment, most likely you don't if you've served. However, there are people who don't qualify for the VA home loan. Also, sometimes there are other options that you might go towards because it just makes more financial sense for your situation. And you may opt to not use your VA home loan. You might decide to go with a low, like 3% down conventional loan, just because you can get a way better interest rate, for example. So I'm putting that out there for you. I'm challenge y'all to go check it out. And also what's really neat about the link to the website, it is on tsahc.org. Again, Ms. Ron will provide you that link, but there's an eligibility quiz on there as well. So you just answer a few questions and you will know right there, are you possibly, a candidate for these special programs? And then you can work further with the people that process those requests. Okay, so here we go. And finally, we have this last common pitfall. For me, it's the most important one. So this one is not shopping around. Can I ask you, do you shop around when you buy sometimes even a pair of jeans? Do you? Give me a thumbs up if you do. Or how about a pair of shoes? You do, right? And we shop around from anything from, I don't know, a pair of shoes to a car. But why don't we do that for buying a home when we're shopping around for our home loan products? Sure, we look at different houses, that we're doing for sure, but we need to treat the home loan as a product itself and the lenders. So according to the Consumer Financial Protection Bureau, the CFPB, I promised you I was going to tell you more on this fact, but 47% of consumers don't shop around for their mortgage products. There's different types out there. Like I mentioned, there's a VA home loan, 0% down, has a lot of pluses, and with any choice, there are pluses and minuses. There's pros and cons, there's gives and takes. And then you might look at a different mortgage product or even a different lender. So I just want to give you a quick example, because this is, by the way, going to be most of us, it's going to be the highest, the biggest, largest financial purchase we'll ever make in our life. So we should definitely start having that mindset that we need to shop around. We need to talk to multiple lenders and see what their products are. What do they have? What are the interest rates? What are their fees and costs for each of them? And compare. So I'll give you an example. If you were looking at let's say $200,000 home, and you went and were shopping around, you saw that you have with lender A, you have a 4.0 annual percentage rate offered for their home loan. And then you have lender B, who has a 4.5 APR home loan available to you. Well, if all other things are equal, because lenders, they'll have some of the same base prices, because a lot of the costs involved with buying a home are going to be based off of a percentage of the purchase of the home. However, there are going to be some lender costs and fees that are just specific to that lender. Okay, so let's just assume that everything's the same. The lenders have all the same fees, costs, and you're just comparing apple for apple. $200,000 home loan, one offers 4%, one offers 4.5%. So just because you shopped around and made that extra call to the other lender, now you know that going with the 4.0% is going to save you $60 a month. And over the span of 5 years, that's going to be $3,500. And so all because you just called and shopped around. And what I recommend my clients to do because I find this works very, very well. Since lenders are really, I'm going to be honest, they're kind of used to people not shopping around. When they know that you are, they get extra motivated to give you the best deal and to do whatever it takes to keep you. So that's a pro tip right there. When you are shopping around and calling different lenders, it's okay. I encourage for you to say, tell them and let them know that you are shopping around so they can give you the best deal. All right, so we can go ahead and change gears a little bit now. And so I want to go ahead and then give you the tips. So your mission is to know your money. So no matter what type of economy we're in, recession, if inflation's happening, no matter what, it is always going to come down to your mission is simply know your money. And I'm going to give you some tips on a few good places to start. Okay. So your mission continued. Let's start with your debt to income ratio. Let's start with plugging the leaks. Fix your credit, know lender expectations, and your overall financial health. And you can do that by taking your financial report card, an assessment. And we'll talk more about each of these as we go. At this time, let me take a quick pause. Awesome. I see the links in there. If there are any questions, I can facilitate up to this point. So glad to see you, Grapevine. I'm in Highland Village and Dallas. Brianna, Dominic, I'm not that far from y'all. Okay, I don't see any questions right now, but where would I suggest you start? Start with your debt. And let's get a little more specific about the debt. So the debt to income ratio, DTI for short, it's going to tell you several things. It's going to tell you your debt as a percentage of income. It's an objective look at your debt. We're not looking at it emotionally. If you will be able to take on more debt, and if you could, how much? If you would qualify for a mortgage. And so it's one measure of financial health. So let's look a little closer at how exactly do you know what your DTI is? So there's an easy formula. And this is it, y'all. It's really just debts divided by your income. That's the DTI ratio formula, your success formula. You can feel free to write it down. I'm going to show you how it works. So step one, we're going to look at your debts, specifically your consumer debts. So we're talking about your credit cards, student loans, regular loans. We are not going to include your car loan because I consider that an expense more than a debt, even though technically it is a debt, but it's another category. So we're not going to include your car loan. We're not going to include anything else except for regular old consumer debt, credit cards, and loans. So we're going to take your monthly payment for each of those debts. And you can see here I have examples. So you have credit card A, and you're making $50 payments per month. Let's just call that USAA. Maybe you have USAA, you're making payments every month. What is that payment? You're going to take your next one, Wells Fargo, maybe. I don't know, maybe for a credit union or one of those. And so there you go. You're going to keep adding them. You can start, even if you have a notepad now, start adding those monthly payments up. If you can think of them off the top of your head, you start adding them up. Once we've done that, we're ready for step two. We're going to take the total. And what's the next thing in our formula? We're going to divide it into the debt, or excuse me, the income. So in my example, and here you see the $900 again. That's my total debt for the month. We're going to divide it by my example, $5,000 monthly income. And if you do that on your calculator, you'll see that you will get 0.18%. 0.18, which is the equivalent of 18%. All right. Pretty easy so far, right? And if you might be wondering, well, what kind of monthly income is it? My gross or is it my net? I always like to operate off of my net income because that's actually the money that you have available to use, right? Okay. So after that, what do you do, Jeremy? All right. After you do that, well, just a recap before we jump further. A recap of what we've done is really taking the monthly payments divided by your monthly income, and we figured out your DTI. Now, in this example, it's 18%. So what does that mean? How do we interpret this number? Is that good? Is that bad? And I'd just like to take a guess from y'all. Do you think this is good, bad, or okay? Let's put it in the chat. What do you think? I don't see any answers coming in. Here we go. We got, it's okay. All right. Thank you. Here we go. We have some more. I'm an English major. That's what I love about this, Ms. Sharon. You don't have to be good at math. Okay. But moving on, I'm going to show you where you land. I just wanted y'all to give it a guess. I'm going to show you. So this is where you would land. 18%. You would land right there between the 16 and 20%. You see that? That's thriving. All right. If you're closer to 0%, anything under 15%, I call that you're crushing it. You are crushing your debt. But this is the sweet spot, y'all. This is where we want to be. We want to be under 20%. The closer to 0%, the better. But I never want you to fall for the belief that you have to be completely debt-free to buy a home. Nonsense. All right. So as you can see, the further up you get up the ladder, then anything over 31%, you're really surviving at that point, because as you'll see here on this next slide, the debt will just start eating away at the other categories of spending. So this right here is the ideal, what I call it, the well-balanced budget. And you can see 15% debt, you would still have 10% to save, which is the minimum recommended that you be saving from your paychecks. So in the example of the $5,000 monthly income, then you would be saving at least $500 per month, because that would be 10%. That's the ideal well-balanced budget. Then you would have 15%. So you would have enough for all the other categories. Do you see that? And housing, for all budgets, for all households, they'll typically look like this. They're going to be, housing category is going to be the biggest slice of your income pie, of your budget. Okay. But as we can see, as I go through the slides, this is still a balanced budget. We're seeing this is the thriving, this is under 20%, but you notice it did start taking an effect on the savings, didn't it? Before you can save at least 10%. Now you can only save like less than 10%, because that debt is really starting to eat into the other categories of spending. Housing now is a little less, living, transportation, and it'll keep chipping away at all the other categories until you have something very unbalanced, like debt taking up 50% of your income. Then we all know that's not a place to be when you're thinking about home buying. Not that not that the lender would even approve you for a loan at that point, but we're trying to stay away from being so unbalanced. Anything under 20% is where you want to be. So if you do the math and you figure, Jeremy, okay, I see where I'm at, and I would like to get that to be better, a lower DTI, lower debt to income ratio. What do you recommend? Well, there are so many things, right? We could be here all night long, all of us brainstorming together the ways that you can save money. But I just like to present to you a few questions that you can ask yourself, because some of these I've seen make a big difference in saving people money. So one question is, can you ask yourself, am I getting the best deal on cell phone services? When was the last time you shopped around for that? There's so many deals out there, and they want your business. I know, because I'm always shopping around, and other cell providers will buy out my contract to get my business to give me a better deal. And I'm all about it. So no, but you have paying for unneeded subscriptions. Are you doing that? Do you pay for magazines or the gym or anything like that? You have to look at your bank statement and start looking, where can I plug the leaks? Ask yourself, have I negotiated rent prices? That's a big one. Some people even say, wait, what? Can I do that? Should I be doing that? Why didn't I know about this? How do you do that? So I'll answer a few questions. And this is coming from a landlord. So yes, you can almost everything. I want to argue almost everything can be negotiable. But with rents going up, it might not have crossed your mind that you can have a conversation with your landlord. Of course you can. You have to approach them, of course, as you always would, very, respectfully, and ask, I see that my rent is due to increase by August 1st, by $50. And here's the reason why I think that, maybe we can keep it at the current rate. I've been an excellent tenant for the last 3 years. I've made my payments on time every time. You never get any complaints from me. I don't play loud music or anything. And so I was hoping that since I've been such an awesome tenant, do you think we can keep my rent the same as what it is? And a few things that come out of that conversation. One can be, sure, you're right. You have been a great tenant. I don't want to lose you for $50 a month, right? The second thing that can happen is your landlord can say, insurance and taxes have really gone up lately, which is why I had to charge, a little bit more for rent. But I agree with everything you've said, that you're a darn good tenant. What I'll do instead, how about we meet in the middle? It'll only be $25 this time. That's a possible outcome. That's the conversation I've personally had with my tenants. And I can tell you, how long have I been a landlord? Maybe I'm going to give my age away if I tell you. But let's just say a long while, more than a decade, maybe a couple of decades. But over that time, my tenants, there has only been one to ask me, and that one got a yes. And on top of that, they negotiated the rent. They also got me to say yes to their big dog, because I was allowing small pets. So I'm here to tell you, try it out. It can work for you. And can you imagine what would even $25 savings a month do for you, right? How many 50-cent coupons would you have to redeem, right, to get the $25 savings? And finally, ask yourself, am I getting the best? Car insurance. Oh my goodness, this is a biggie here for saving as well, because with shopping around, making, let's say, 3 calls, maybe you're with USAA, right, and you decide to call, I don't know, Geico, Allstate, you name them, and you have 15-minute conversations with each. I would challenge you to spread it out during the week. So maybe on Monday you call one, shop around. Wednesday you call the next, and Friday you call the last one. They're 15-minute phone calls generally about, and you're taking your notes, you're shopping around, right? You might find that you are paying $50, $100, $150 more in car insurance per month than you need it to be. And the reason why I tell you that is because I've had clients who I've asked and challenged them to do this. And literally in 15, 20 minutes, we found out that one client in particular, he was 24 years old, and he literally saved $150 in one phone call. So it just boggles my mind. And I'm not guaranteeing that for you, right? Because it is very dependent on variables such as age, driver's age, are they smokers, what kind of, previous driving history they have, credit score, et cetera, et cetera. But what I am saying is, what if you only could save $25 or $50, right? Here we go. So I challenge you to do all of these things to start plugging the leaks. You'll find more places where you can save money when you really want to get serious and focus on your mission, which is home buying, right? And so once you've done that, you've understood how you can save some money and you freed up some extra money, then you can start bringing that debt to income ratio down. Okay, so now that we've looked at the debt, how are we going to plug leaks to get that debt to income ratio down? Let's switch gears into the next item on your list, on your mission list, which is fix your credit. Let's fix your credit. There are so many ways that you can help yourself for free. There's a to-do list right there I'm giving you. Pull your credit report free. Fix credit report errors. Cost to you, $0. Make on-time payments, $0 cost to you. And then credit utilization, that depends, and we'll talk a little bit more about that in a moment. But I do want you to note the annualcreditreport.com website, because that is where you can access 3 free credit reports per year paid for by the federal government. So that's a really great additional resource. You're probably getting free credit reports from where you're banking or some of the other free apps out there. I like this one because it's what is it called? It's an endorsed by the government. So this they're not going to upsell you here. They're not going to have all those pop-ups that come up advertising to you, and it's a legitimate resource. All right, so credit utilization. I want to delve a little deeper into this because you're wondering, what's that? I don't know. I've never heard of that. So let me show you. So FICO score factors, there are 5, and FICO score is the #1 credit score provider. And as you can see here, FICO tells us these 5 factors that are important and that they use to weigh how they come up with your credit score. As you can see, payment history that I'm highlighting there, pointing the arrows there, and credit utilization are the biggest slices, the biggest factors that go into it. So payment history, I'm not going to spend a lot of time on that because that I'm sure y'all are doing this fantastically, where you're making your payments on time every time, not just sometimes, and for every debt, for everything that you're paying, right? But let's focus more on, and then by the way, that accounts for 35% of your credit score. So keep up the good work, keep doing that. But how about credit utilization? What exactly is that? So that is what FICO calls how much balance you're carrying on each individual credit line, whether it's a credit card or a loan. And so if you have a credit limit and a balance on there, the balance to the credit limit, that is called credit utilization. And yes, y'all, it is another ratio. But I promise it's really easy to figure out. And between those two, if you can just focus on continuing to make those payments on time, and you can focus on keeping your credit utilization ratio down enough, you're 65%, you're influencing your credit score. So let's go ahead and look a little bit more. So the relationship really is if your credit utilization is high. So if you have a credit limit and your balance on it is up to the credit limit almost, that credit utilization is high, then that means your credit score is going to go down. Okay, so what's the rule around that? How much of a balance should you carry on a credit limit? So the rule of thumb is keep your balances at less than 30%. So that way your credit utilization ratio is 30% or less. That is where you're going to gain the most points. So let me give you an example. So when you have a $1,000 credit limit, for example, and you're carrying a $400 balance, here's the little formula again, y'all. This is the ratio. You take the $400, you divide it by the $1,000 credit limit, you're going to get the 0.4, which equates to 40% credit utilization. So you're doing pretty good if you're here, because if you can get your credit utilization to 30% or less, that's where FICO score is going to give you the most points. So be really strategic when you begin thinking about paying down debts, because what you would want to do is, with the money that you're going to be saving from plugging the leaks from what we talked about a few slides back. Okay, so with that money, when you start freeing up the money and you're plugging the leaks and you start bringing down your debt, be strategic. If you have a credit card, let's say that's $1,000 and you have a $50 balance on it, and then you have $1,000 credit limit with another balance on another card, and you have a $900 balance, pay the $900 balance one, because that's the one that's going to have the higher credit utilization ratio, not the one that has a small balance on the $1,000. Okay, so let's switch gears to a few lender expectations now that we've covered where to start. We're going to start with debt to income ratio, and then we're going to fix our credit. We're going to work on these things. We're going to be doing this a year out because we don't want to fall into those pitfalls, right? So let's switch gears and look at some of the expectations lenders have on you. So there are a few. There are more than this, but I just wanted to highlight a few because sometimes this might catch you off guard, because we're spending so much time thinking about everything else. We might forget, or we might not even know that lenders also want to see, in addition to your awesome debt to income ratio, your credit score, they want to see some money in the bank. Even if you're going to go with a 0 down VA home loan, they want to see money in the bank. They want to see that you have 2 to 3 months of a savings account where you would be able to afford your mortgage with no problem, should you not have an income, or should your hours at work be reduced, should you have an injury where you maybe bring in some income but not what you're used to. That's what they want to see, y'all. So understand, you have to have money as cash reserves. They're going to want to see that. Otherwise, you're going to pose a big risk to them, that anything can go wrong at your job, and even for a week, and they won't want to give you the home loan. So the other thing is, they look at 2 years of work history. They want to see that consistent full-time. There are any gaps, just a heads up, you're going to have a conversation and fill them in on what's been going on. They might want a lot of documentation around that. And so just have that on your radar. Also, they're going to want to see that you're paying off unpaid collections. And I only bring this up because I know some of y'all, it's been years and years ago that things have gone wrong, and some credit card went to a collection, right? And you PCS while you were in the Army, and then you forgot to give them the change of address. And before you know it, you were over here overseas. And then 2 years later, you're like, oh my gosh, I forgot about that. Forget it. It's already hurt my credit. But guess what? The lender's not going to forget about it. And so I just wanted to bring that to your attention. Typically, if you have these unpaid collections and things, they will fall off of your credit report eventually, but it does take 7.5 years. And a lot of people say it's 7. Technically, it's 7.5 because it's 7 years after it's gone to collections, and usually it will take about 6 months for it to get there. So yeah, so there's another website, consumerfinance.gov. That is the federal website where you can go and get a lot of information about home buying from a federal source. So there's no trying to sell you there. You're going to get unbiased, good information. And I know Ms. Sharon's going to provide that link to you as well. It was the consumerfinance.gov/owning-a-home. And there you can download checklists, you can, there's so many things in there, but I encourage you to go. All right. So in conclusion, y'all, we've kind of come to the end of it already. I was really enjoying presenting this information to you, but really, it's all about home ownership is possible. Of course, you have to accomplish the mission. You've got to know your debt to income ratio. You're going to plug the leaks. You're going to fix your credit on your own. You don't have to pay a company to do that. And you're going to know those lender expectations ahead of time. You're going to understand those common pitfalls. You've taken notes. You've got some resources. You've got some websites to check out after this. And so while I understand this presentation was not a masterclass on all things, you should know for your target, which is home buying, it does give you a little head start. It gives you some information and direction. Now, I want to remind you that this also is only part 1, Reconnaissance. And also, I'm only one speaker tonight. I'm going to be giving the floor to my colleague here in a few minutes. But before I do that, I just wanted to remind y'all, this is part 1. This is a 4-part series. There's more to come. You're going to hear from the lender's perspective. You've heard from an accredited financial counselor's perspective on what you can afford and such. And they may tell you the way that they calculate a debt to income ratio, which you'll find is different from the way I do, right? But anyways, at this time, I would like to see what are your questions with that said?
Jeremy, if you don't mind, I'm going to hold the questions till the end because I think we got some eager people who want to compete for the gift card. So before we do that, and before I introduce the next speaker, for those who are participating in the audience, I'm going to ask you to keep yourselves muted and please keep your cameras off. But I'm going to ask you some questions. If you can please place your answers in the chat, then the person who gets the majority of questions right will be the winner of tonight's gift card. But if we have 2 people who are neck and neck, instead of giving away one $50 gift card, we can give away 2 $25 gift cards. So cue the pretend Jeopardy music. I'm going to ask these questions, please. Okay, I'm going to ask these questions and please put your answers in the chat. All right. What is the origin of the word mortgage? Again, don't unmute. Don't turn your camera on. Please simply put the answer in the chat. What is the origin of the word mortgage? What does DTI stand for as it relates to mortgages? And I kept foot stomping all through and that's for us Army vets. I kept saying foot stump, foot stump. What does DTI stand for as it relates to mortgages? And last but not least, what is the definition of the word reconnaissance? Now, Miss Rachel, she's going to start speaking. I'm going to put these questions in the chat. The first person who gets the majority of the answers right will win a $50 gift card. And if we got 2 people who are kind of neck and neck, we can give away 2 $25 gift cards. But thank you so much. And Miss Rachel, we're looking forward to what you have to say. And I do want to say real quick that Rachel, she's an Air Force retiree. And since I've ridden in a couple of C-130s rolling down the strip during my Army career, I'm bestowing on Rachel some honorary Army swag. So, ma'am, please go right ahead and just enlighten us, and just please further tell us some of the offensive, defensive, and offensive objectives and maneuvers that we can do in order to protect those we love and to prepare for major purchases. Thank you so much, ma'am.
Hi, everyone. I was just about to message Jeremy. He's like, hey, give me 1 second.
Go ahead, Rochelle.
Okay.
Mhm.
Apologize, guys, for the small technical difficulties. Give me a second.
Okay, and as Rachel pulls up the screen, I do want to tell somebody sent me a message, direct message me, and basically, if you can answer the questions, the winner who gets the most questions right will win a $50 gift card. If we have two people who they're tied with it, we can give away two $25 gift cards. So that's what you missed, and I'm going to post them so you can compete for the gift card.
All righty. Hold on, guys. We still having some small technical difficulties here. All right. All right. Hi, everyone. It's really a privilege to be here and to follow fellow veteran, Ms. Jeremy Chavez, as she provided some time-sensitive financial tools to help you prepare as you embark on your home ownership journey. I'm here to build on that information and primarily to focus on the next step in the process, which involves protecting your home through mortgage protection, utilizing customized life insurance. Here's a little bit about myself. My name is Rachel Roach. My nickname is Ray. I am originally from Nolens, Louisiana. Yes, I did pronounce that correctly. If you're from there, it is Nolens. You're going to hear a little twang throughout this presentation. Try not to hold that against me. I served 23 years in the world's greatest Air Force. And right now I am currently an agent with New York Life. And I'm excited to share how life insurance can help protect your long-term investment, which is your home. All right, so building a financial strategy begins with protecting what matters most, which focuses on the financial security and then builds towards financial success. The bottom line is we start from the bottom up. To begin, we focus on our defensive objectives, right? Which involves protecting what you earn, what you own, what you owe, and those you love. Then you can pyramid up to offensive objectives, which is to prepare for those major purchases, those emergency funds, the college education and retirement. Then we move up to more aggressive strategies, which involves maximizing your qualified plan contributions, which is also known as your TSP. And then lastly, after you've positioned yourself to pass along assets, you're focused on estate conservation, tax efficiency, and business continuation planning if you're a business owner. And so we begin where we spend each day. So there's protecting your house, which is also known as your property. And then there's protecting your home, which includes mortgage protection and your family's ability to remain in the home no matter what. So owning a home, as Ms. Jeremy just discussed earlier, is a huge accomplishment and a big responsibility. Homeowners are generally focused on three specific needs. And I want you guys to remember this acronym, Papa Foxtrot Alpha. The P is for protecting your long-term investment. The F is for the flexibility as your needs evolve over time. And A is affordability. Our approach is to help create a peace of mind. I mean, as you guys have heard throughout the presentation so far, this can be a stressful endeavor. We're here to try to help with that by covering your mortgage payments, helping you preserve your current lifestyle, and providing portable coverage. To expand on this, I'm talking about complete customized protections that focus on short, midterm, and long-term protection. This involves a cost-effective term insurance, term life insurance, so your family has more protection during the early years of home ownership, combined with long-lasting life insurance policies. And examples of those are whole life or universal life, and that will cover the entire length of your mortgage and more. And here's a depiction of that layered approach I just discussed. This approach focuses on utilizing the term insurance for your short to mid-range protection, which is when your debt is the highest. Essentially, when you first purchase your home, you haven't made any payments. So essentially, that is where the bulk of your financial needs will occur in the first 10 to 15 years. But also, you also simultaneously have long-term protection that covers the entire length of your mortgage as well as more. So even when your mortgage is retired, when you paid your home off, your coverage is still hard at work. You can use the remaining coverage to protect your family's lifestyle, to create a tax-free inheritance for your loved ones, or possibly even help generate supplemental income for retirement. Now we want to move on to the benefits of mortgage protection with New York Life. I mean, they're all listed here. More complete mortgage protection, customizable coverage, the opportunities for asset growth that can provide future tax-free income, and living benefit protection that makes the solution versatile as your needs evolve. The bottom line is it's optimal. It's an optimal life insurance solution that fits your budget and enables your family to stay in your home if something happens to you. No matter how often you move, how frequently you refinance, or whatever happens to your home value. As we work together on the next step, we'll analyze your needs and determine the amount of protection you need that fits your budget and protect your loved ones. At New York Life, every decision we make, every action we take has one overriding purpose: to be here for you, our policy owners, when you guys need us. New York Life has been protecting families since 1845, and we have decades of proven financial strength. And this concludes my presentation. It's been an honor and privilege to discuss mortgage protection with you all. I understand it's short and sweet, but I think my point has been expressed, and I am available for any questions.
Thank you, ma'am. I greatly appreciate that. I believe Jeremy had a couple of things that she still wanted to post in the chat. I have now, before we announce the winners of the gift card, I do believe we have a couple of questions. So Jeremy, there's a question for you, ma'am.
Excellent. Okay, let me see.
Okay, now, if you're still putting, I know you had a gift that you wanted to gift our audience, which is absolutely phenomenal. Rachel, so if you're still putting that financial report card, it's honestly like chef's kiss. So if you wanted to put that in there, I'm going to actually use that again myself. It's like a financial tune-up. But Rachel, ma'am, I have a quick question. Ma'am, what's the difference between PMI and mortgage protection life insurance?
So, okay, I'm making sure I'm off mute. So PMI is essentially private mortgage insurance that protects the lender in case the individuals default on their loan.
Okay.
Whereas mortgage protection for life insurance protects the individual, their beneficiaries, and their loved ones.
Okay, awesome. Phenomenal. Absolutely phenomenal. All right, and Ms. Jeremy, there's a couple of questions for you.
Okay, great. I'm ready when you are.
Yes, ma'am. Now, what are some practical ways to lower debt?
Yeah, so my best tips of lowering debt is really getting organized. I've had a lot of, clients have the same goal, of lowering their debt. And the first place is really getting organized, because sometimes we don't have all that information in one place. So just really, do you get e-statements? Are you getting some of your bills and statements that way? Do you get some snail mail? Do you have some of the bills you take to the office to go take care of those on your lunch break? Do you have some at home, stacking up, collecting dust? So really the first thing I would say is get organized. And once you can do that, I actually use a tool where you can learn about different ways to repay your debt. And I don't know if some of y'all have heard of like the debt snowball. That's Dave Ramsey's, he coined that, but really it's just a way of being able to repay debt. And that prioritizes maybe your highest interest rate debts first, or your smallest balances first. And you can do that. You can do this, what I like call, organizing your debts in one place and looking at the different options to repay back. I didn't give you this website, but I can give it to you now. It's powerpay.org.
Mm.
And that one is a free website. It's a free debt. We call it self-directed debt repayment plan that you can make yourself on this free website, because it's actually the Utah State University Cooperative Extension who offers this to anybody who would like to use it. So again, I like to use websites and tools that are not going to, advertise, upsell you, they seem to be free, but they're really not. And so powerpay.org is one of those tools. And that's what I would do, is start getting organized, figure out what exactly you have, go to powerpay.org, and then you can input that information. And the cool thing about the tool is it will offer you, okay, here's 4 debt repayment options you have. Which one do you want to go with? Do you want to pay your higher interest rates first, lower, etc.? And then you can see what makes the most sense for you. Sometimes people, it's not so much about saving the most interest. It's about seeing that they're making progress. They really need to get that going and start paying off the smaller debts first. So that's my tip, along with, of course, the plug the leaks, which that's a way that's going to help you get out of debt quicker, is just noticing where are your leaks.
Okay, ma'am, I had one more question for you. Will shopping around for a mortgage hurt my credit score?
Great question. So each time that we have a lender, a creditor, look at our credit, it does affect. And those are called inquiries. And the thing about the algorithm that FICO uses to determine our credit score is that the algorithm, right, the little computer behind the scenes figuring out what our credit score is, it has built into it. It just knows that you're shopping around, whether it's for a car loan, whether it's for a home loan. It will give you, it'll affect your score less because of that. So if you're doing some shopping around and you're doing that all within a month, you can shop around and that will be affected less. But yes, it is true that every time you have a lender or a creditor pull your credit, it will affect your credit score slightly. And usually those come back, those few points that you might lose will come back within a couple of months.